An LLC is the entity that is pretty much always used for real estate. It's like 99.99% of the time. If there's a lawsuit and a liability and there's no LLC, then that lawsuit goes to the owner, which means their personal assets could be seized, and that could ruin somebody's life.
Welcome everyone to another edition of Ask the Multifamily Expert. And with me, I have my CPA, the one that helps us to, I'm going to dive deep into that later on. But in this particular episode, we'll be discussing more about tax strategy. And why did we decide to put this at this time of the year is because as the year is wrapping up, some of us are lost with, other activities, and we are forgetting to understand that come March or April next year, you will be filing your 2024 taxes. And maybe there are some decisions that you should have made prior to the year closing that you didn't make, and you might not be able to take advantage of some opportunities. So we decided to bring in one of the finest tax personnel you can imagine and think of to come today to tell us what are the opportunities, how can we start structuring our businesses so that we can take advantage of this. But before I go into that, I want to give you a background story. One of the reasons why we started the multifamily was because of taxes. My business partner was being slammed with heavy taxes due to his business. He was receiving a lot of income but less expenses. So after the year, every time they were slamming him with 700,000, sometimes $1 million and all that. So he felt like, yes, I'm making money, but like 50% is going back to the IRS. He's still looking for other ways he can maximize or minimize his tax liabilities legally and all that. So that was how we started multifamily. But there's something you need to understand. Not all CPAs know how to do the multifamily or the real estate part of taxes. I've spoken to many CPAs and I know not all of them are aware of the opportunities that you can take. So we decided to partner with Wettability. Wettability is owned by Tom Wheelwright, and he linked us to one of his affiliates, which is Pro CFA. And Michael is actually one of the CPA, in short, our direct CPA that handles all our books. And I can tell you for a fact that since he took our deal, our investment, we've seen a significant tax benefit. We've been able to write off our tax legally. I want to state that fact, legally, just by them doing what they know how to do best. So today I'm going to welcome Michael. I don't want to spoil your last name, so I'm not going to mention it, but I want you to introduce yourself to the guest. Who is Mike Cassell?
Hello, everybody.
Right?
Yes, no, yeah. So yeah, my name is Michael Casali. I'm the Director of Operations of Pro CFO, and the majority of my clients we have with the firm are real estate-based clients. And that can range from multifamily also into commercial as well. As a little bit of background on myself, I've been in the accounting industry for about 20 years, and then I was also in commercial banking. And then prior to that, I was also in commercial real estate. So, among real estate, finance, and accounting, I've been in this industry for a long time. And I personally have become involved in multiple real estate investments and advised people, not just on the tax aspect of it, but the operations of it as well, which there is a component that connects with the tax, which someone always kind of wants to be aware of as well too. But so that's my background, and we have the majority of our clients are looking for some sort of way to take the funds from their business and invest it in assets, and the reality is that the majority of them invest in real estate.
Thank you so much for introducing yourself. I know you guys are going to have a good time, but before we dive into the question and answers, I would like to state this. If you're not following us on our YouTube channel or on our Facebook, which is Blue Ocean Multifamily Group, then you're missing a lot from our content, because we go right into the A to Z of multifamily, how you can partner with people, how you can leverage on different opportunities, from the acquisition part to the guarantor KPs down to the end of a deal, exit strategies, how you can structure your deals. If you need to start up your multifamily journey and you're kind of confused, you can go to our YouTube channel and just get excited and go through our videos. You'll have a wonderful time. So, Michael, we're going to go right into the questions for today. The first one I'm going to ask you is on the passive income and tax deferred strategies. The reason I'm asking you this in particular is because I've seen W2 investors asking me this question, saying, how does investing in multifamily generate passive income, and how is this income typically taxed? And the reason why I'm asking you this is multifamily, they get to generate passive income. That is an additional income to whatever it is they are earning on their active income, which is their W-2. How is that typically taxed for a W-2? Yep.
Yeah, it's a very good question. So passive income in general, there's two ways of looking at it. What I found there is the non-tax way of looking at passive income, which essentially is for the people who are on, let's say, W-2 employees or something else, and they're trying to build other income, which is passive in the sense that they don't have to spend that much time on it, which obviously there's benefits to that, so they can grow their wealth. But from a tax perspective, passive income is that which they're not earning, and it's real estate, stock investments, capital gains. The important thing, passive income, when that comes through to somebody's individual tax return, and let me just make a small little side ramp, that most real estate investments are held in partnerships. And yes, the legal structure is an LLC, but the partnership, an LLC being taxed as a partnership, is the ideal entity to hold real estate investment. And I say that only to point out that when the money comes from that investment, it passes through, which is not to be confused with passive income, but it passes through from the partnership to the individual on their 1040 individual tax return. Okay, so now we're talking about the tax aspect of passive income. That comes through, and if we want to get technical, it goes on the Schedule E and eventually makes its way to the front of the 1040. So income is income and it's taxed just as normal. An important thing though, and actually a lot of times the incentive to invest in real estate is you have losses that come through. And I know we'll probably talk about this in a little bit more depth later into the interview, but one has to be concerned that when those passive losses come through, that they can be fully utilized, ideally, to offset their other income. But just talking about the income itself, passive income, that's going to come through and be taxed just as all its other income.
Okay, so in other words, it's not just for you to invest in multifamily or any form of real estate or investment. You need to also have this conversation with your CPA or your lawyer to see how you can structure your business.
Exactly.
So,
Yeah.
okay.
And the issue, Bibi, is that a lot of people, unfortunately, one aspect is that we've seen some people put real estate inside S corporations. And the issue is if you want to take an appreciated asset such as real estate, appreciation meaning that it was one value when it went in and then it appreciated in value. If they want to take that building out that they contributed in before, that's going to trigger a taxable event, and they're going to have to pay capital gains tax, even though no cash has been received. And that's why I was saying that a partnership is really the ideal entity to invest in real estate. But either way, it comes through taxed as normal income like it's other W-2 income.
Okay. My next question to you is, what are some effective tax strategies, deferred tax strategies that multifamily investors can use to grow their wealth while minimizing immediate tax liabilities?
Very good question. And probably it's the primary reason why people will invest in real estate. And, a lot of people are getting involved in real estate not to manage it or to be involved, but really to get the benefits from it, not just from the income, but also the tax advantages is what we see a lot. So in the real estate world in general, regardless of the entity, the two most common tax deferral methods are 1031 exchanges and cost segregation. So a 1031 exchange, in essence, is a voluntary dissolution of a property. And then within a short period of time, you're taking the funds from that property that you sold and you're investing it in a like kind property. So capital gains, meaning, the difference between what you bought it for and what you sold it for, like anything else, if you're going to sell it for more than you bought it for, that gain that you got is normally going to be taxable. But you can defer that gain by taking the funds from that sale. The important thing is to make sure that you take all of those funds. A side note, you want to make sure you don't ever take any cash out of that deal. Otherwise, it's called boot, and that's going to be taxable. But that's a little bit more of a detailed discussion. But in any case, you take these, and you normally need to use a 1031 exchange intermediary as well. You can't touch the funds. But the idea is you take that building, you sell it, it's a relinquished property, and then you buy a like kind property, which is called the replacement property. And with that, you're deferring the gain. So that's a 1031 exchange. Cost segregation. Okay, so the way that works, the issue with real estate, this all revolves around depreciation. Depreciation is something where someone's going to take a certain portion of the cost of the real estate that they bought and then expense that against the other income that the property property is earning to then reduce the taxable income, thus reduce the tax. Now, with real estate, normally, I mean, just naturally, it's supposed to last a long time. So obviously you buy a computer, it's going to last maybe, 2, 3 years. A tractor or
Of
some
course.
other, yeah, it's going to last like maybe 5 or 10. Real estate generally is going to last a long time. So the IRS puts these depreciation rules on real estate that we can't choose how long we're going to depreciate it, or better said, we can't choose how much depreciation expense we're going to take per year. The IRS says no. If you have residential rental real estate, it's 27 and a half years. You have to depreciate over that. And if it's commercial real estate, multifamily, it's 39 years. So it's like, okay, wow. Well, if I'm taking, $2 million of a real estate investment and depreciating over 39 years, well, that's not as much depreciation as I wanted to. Okay, so that now where a cost segregation comes in, normally, even if you look at an apartment building or multifamily property, the whole thing is not going to last 39 years. I mean, there's going to be certain things that are going to go that need to be replaced in 5 years or 10 years or 15 years. But it's difficult when you look at a property to say, okay, well, we're just going to take 25% and say that it's 5 years and then depreciate that over 5 years, which you'd get, a bigger expense. So what the IRS allows is for there to be what's called a cost segregation, which needs to be done by another cost segregation firm. What they do, it's almost like you kind of think of it as an appraisal. You don't, if you need to get an appraisal, you don't do the appraisal yourself. You hire someone to do it. And then that appraisal kind of can stand on its own. Same with cost segregation. I'm going to hire a cost segregation firm, and they're going to say, okay, well, based upon our analysis of this, let's say $2 million property, 500,000 is land, and that can never be depreciated. This is an example. Another, let's say 750,000 is 10-year property. And so that can be depreciated over 10 years rather than 39 years. And the other 750,000 on top of that is, let's say, the other 39, year property that needs to be depreciated over 39 years. But that 750, and a lot of times it's broken up in more like 5-year property, 10-year property, 15-year property. You could find a certain property or a building where, maybe only, it depends obviously, but maybe only 40% or 30% is that 39, lifetime property that needs to be depreciated over a longer period of time. Anyway, so you have this 5, 10-year and 15-year portion. So the way this works and the way this really has a benefit is it's not only that you actually can take more depreciation and reduce your taxes when you do your tax return. What comes into the picture as well is bonus depreciation. Okay. And so 3 years ago, it was 100%, then it was 80%, 60%, but it still exists. So where bonus depreciation exists is for any fixed asset that has a lifetime less than 20 years. So not 20 years or less than 20 years. And with that, you can take 60% of the depreciation of the cost within that realm. So the 5, 10, or 15 property, and fully depreciate in that year. And so maybe what happens is people will get involved in, multifamily or commercial property, and they have other income. So they have, assuming that it's going to be treated as active, but that's another discussion itself. But if they, let's say I have other passive income. So from another property, it's producing a lot of passive income. They invest in a multifamily property that has 60% bonus depreciation. All of a sudden they can depreciate. Let's just come up with a number, $500,000 of depreciation. That can totally erase $500,000 of passive income. That's massive, because that means that massive. And that's where the benefit comes from that. And usually these cost segregations aren't really that expensive. I mean, usually the return on investment, if it's done properly with a good property, it's massive on that, or it's really significant. Yeah. And so those are the two things.
I think the one we did was about 6,000. Yeah, for a 120 unit. But yeah, before you go further, what is the catch up like when you're exiting a property when it comes to 1031 exchange or using bonus depreciation? Because I hear that if a form of catch up that might happen. So what is it? What is that like, and what is the strategy to avoid that?
Okay, so when you're using 1031 and cost segregation together, right?
No, separately. No, two different. Yeah,
Separate. Okay, yeah.
separate.
Okay. So with cost segregation, a really nice thing about this is a lot of times in the tax realm, you can only benefit from what you're doing in the year that you're doing it. And if you could have done it before, like, oh, you know what, I should have done that. The good thing about cost segregation is you can catch up. So if all of a sudden you bought a property 3 years ago, it's like, hey, you know what, I should have done cost segregation on that. The benefit is you can do that now and catch up with cost segregation and all the depreciation as if you were to have done it from the past. But obviously you're gonna accumulate all that benefit, all that expense that you can deduct right now. So as of right now, I should say, there was just an election yesterday. They're obviously going to be be, making adjustments. The Tax Cuts and Jobs Act, there are certain things that are set to sunset at the end of 2025. But with, the fact that, who won the election, they might extend that. But that's something to, definitely want to take advantage of, or sorry, to keep an eye on. And what we're doing as a firm is we're always keeping an eye on that, not just on what's available right now, but what's being discussed in Congress. So we know ahead of time how to plan. But yeah, those are the two things: 1031 exchange and cost segregation, the main tools to defer tax in real estate.
Yeah, let me tell you this. I've slowed down in using 1031 exchange because really it doesn't give me the benefit of enjoying, should I say, the fruit of my labor. Like you buying a property, selling it, you make money.
Yeah.
And I've started using the K1 from those deals to write them off. Is that a good strategy if you are someone that likes to, like, not to reinvest that money, but maybe you want to use it to do other things? Is it a good strategy that people can do?
You can do that. And now that we're talking about, like, let's say somebody did not want to do a 1031 exchange.
Yes, someone like me.
Yeah. So another thing that you can do is there are things called qualified opportunity zones, and that needs to be funded with a qualified opportunity fund. So what's the benefit of all that? So the benefit of that was also created by the Tax Cuts and Jobs Act. The idea, in just a few words, are that realized capital gain that you've gotten from selling real estate normally would be taxed. So realized meaning that you actually got the cash, as opposed to unrealized where just it increased in value. So realized you sold property. You're like, you know what? I kind of don't find any other like kind property. I don't want to do a 1031 exchange. There needs to be a benefit as well. You also have like a time limit as well too. So like you need to identify the property within 45 days and close on it in 6 months. I mean, time goes by fast. And so if you don't want to just buy something to buy something. What if the economy is going down, interest rates are going up, or I mean, you don't want to just buy something just to take advantage of it if mathematically it doesn't work out. So like, all right, well, now what do I do? Do I have to pay tax on it? So an opportunity zone, that is, if you want to think about it, it's a lot of times low income or other stressed communities where the government's trying to have more money come in there to revitalize the area. And so what you can do within 6 months of realizing that capital gain, meaning that you actually 6 months of selling the asset, you can put those funds within an opportunity zone fund. Yeah. Opportunity fund, which then invests in an opportunity zone. And the best way to take advantage of that is to leave the money in that fund for at least 10 years. Now, I know that's a long time, but if you're looking at your portfolio, like, all right, well, you know what? I'm fine to leave that there for 10 years, which then would completely erase the capital gain, the taxable capital gains on that. And that's kind of a lot of people don't know about that because, there's a.
Oh, I
there was-
don't know. Please walk us through this process.
Yeah.
For someone that does not want to do a 1031 exchange, start again.
Yeah. What there was, it's actually not available anymore, but there was an opportunity to, sorry, I should use a different word. There was something available where people could leave in the funds for 5 to 7 years, and they'd have a step up in basis. So what that means is, when you calculate capital gains, it's like, all right, so that's what I bought it at, and that's what I sold it at, and so the difference between that is my gain, which I have to pay tax on. But what you bought it at, that's considered the basis, tax basis. And some of your viewers may know what that means. For anyone who's not, I'm just trying to explain it, because in a maybe more basic term, what you bought it at is the basis. So now in the past, actually just a couple years ago, it made sense to keep it in there for 5 to 7 years because you could have an increase in basis, which means you theoretically have bought it for more. And if you're selling it the same amount, you have less gain. It costs you more, so the difference is less, and therefore you have less gain, less tax, more money in your pocket.
Right.
The deadline on that was 2026. So that means you would have to invested 5 or 7 years prior to that. So now, like, all right, well, now what do we do? So now what you do is you can keep, and this is even after 2026, you can keep the money in that opportunities fund, which is within the opportunity zone. That's important that actually you don't just keep it in the fund, you actually keep it in the zone as well for 10 or more years. And then there's no capital gains, taxable capital gains. And like if you're talking about a lot of money, it's like it's a lot of tax saving. I mean, you're just completely wiping out the tax you have to pay on that. So that's really where one can use on that.
So let me understand this opportunity fund that you're talking about. Is it who sets up that fund, and do you take take out from the fund to buy a property in the opportunity zone? How does that work?
Yeah, so there's a lot of things which we can't do. So a self-directed IRA, which can also invest in real estate, that needs to be done by a custodian. A 1031 exchange needs to be done by a 1031 exchange intermediary. But the good
Right.
thing with an opportunity zone, and I actually just did this recently for one of our clients, it's an auto declaration. They just say, hey, I'm doing this. Now you have to file some more forms with your tax return, which we can do for people, obviously, but it's not one of those things where you have to have someone else involved, like a lawyer or some other group where you can't touch the funds. And if you do, bad things happen. So that's actually a good benefit on that. And then there's a decent of number of other rules as well that one would need to follow, which we always guide people through. But generally,
Mhm.
it's I personally feel, baby, that it's a underutilized tax benefit. And yeah, I
Yeah.
mean, it is 10 years, but I've seen people invest money in businesses for more than 10 years, just hoping to pull something out of it. I was looking at a recent study just a couple months ago where it said that of all the funds that were invested in the United States, a massive proportion is invested in real estate. I mean, just recently now, what's going on, and a smaller portion is invested in businesses. So that in itself, I think people are looking long term and they're fine to leave their money in real estate because at the end of the day, if that's creating an asset, and here's another discussion as well, BB, generational wealth. That term's thrown
Yeah.
out quite a bit. I do feel that people are becoming less and less inclined to let other people manage their money. I mean, and I think we've
Mhm.
all seen it ourselves. Anyone who's been involved in investments, you've looked at your investment statement like, why are my fees like $5,000 to pay this investment advisor, and I didn't get that much of a return?
Exactly.
I could kind of look this up myself, and I think this is also the reason why so many people get involved in real estate investing as well, because they can do the research specifically.
Themselves.
You know yourself, baby. Like when someone's looking at a particular part of the country, like I grew up in Charlotte, North Carolina, and most of the investments that I look at in the United States are in Charlotte, North Carolina. I know the area. I grew up in Charlotte, North Carolina. I know the neighborhoods and things like that. And I feel that's actually the best thing to do as well. But I'm doing my own research. That compared to giving money to an investment advisor, and who knows what's going on with that. I mean, I remember I had a discussion with an investment advisor one year, and it was weird because I was asking him, so, tell me, what was your decision process on putting these funds in these, let's say, or putting my money in these funds? Because we actually had a loss this year, but generally the economy was going up, and I mean, I didn't really get much of a good response. So
Exactly.
yeah, I have a degree in finance and accounting. I'm a CPA, and I was expecting a lot more. Okay, well, the reason we did this was because of this strategy. I didn't really get any of that. I'm like, I'm paying you guys like a certain percentage, which adds up to a lot of money, to lose money for me. No, forget that. And so I think people are waking up to that. Like, I just no,
Yes.
we're not gonna
I
do that
think
anymore.
I listened to a podcast and that was the conversation that we're having and all that. I think that this is one of the reasons why we are doing things like this, to educate investors, because the more education that they have, the more they can take the right decision in their investment
Exactly.
journey.
Yeah.
You don't always want to rely on maybe, I'm not trying to say there are no good ones out there, but the thing is, some of them don't do the due diligence. They are incentivized by the amount you're paying them as commission. So if they're getting you into other investments, they're getting some form of commissions on it. So that is what the incentive is for them. So you just have to be able to wither the shaft from the wheat to know which of them are right for you, or you do the legwork yourself. I will greatly
Exactly.
advise you to do the legwork yourself, do your due diligence and see if that investment suits you. So I want to pivot to another conversation, especially concerning entity structuring, because I know this plays a very big role in how you can write off your taxes legally. So my question to you is, how does entity structuring affect liability protection and taxation for multifamily investors? And what factors should investors consider when selecting an entity?
Okay, very good question. So what we are seeing pretty much 99.9% of the time is people are investing in real estate with an LLC. Okay. So now an LLC in itself is a legal classification. And it's easy to think that it's a tax classification, but an LLC can be taxed however one wants it to be. LLC is there to protect the assets within that group, but also to protect the owner from any liabilities or creditors that would come about from that. Now, this is kind of excluding that, assuming somebody didn't personally guarantee a loan within that LLC, and that would mean that the loan is non-recourse. So that's an important thing for investors to know. Then whatever happens in the LLC stays in the LLC, and the creditors can't go past that. One one also needs to make sure that they're keeping, certain corporate documents in line, that they're not commingling funds, that they're not putting personal and business. That's kind of a side note, but it's important to note as well too. So an LLC is the entity that is pretty much always used for real estate. It's like 99.99% of the time. Okay, now comes the tax classification. Once again, with that, I only see two classifications generally. And I should say three, but it's really two. One, and it's not really ideal, but it depends on the person. But if someone is going to be owning the real estate in a C corporation, that's fine. But there's got to be a bigger reason for that. And it's usually tied to the business. And I would think that the majority of your listeners are not perhaps wanting to do this. This is maybe more of an entrepreneurship oriented discussion, and the viewers as well too, where they have their W-2 income and they're looking to invest in real estate. To open up a C corporation and include all the costs that would come about that, and just to have real estate in it, that's if like you're running a business anyway. But the two other common ones are still LLCs, but the LLC is either going to be taxed as a partnership or it's going to go straight to the individual. And someone say, well, what's the difference? Okay. If someone is completely by themselves and like, I don't want anybody to be involved with me, I don't, then you actually can't have a partnership, but it's still an LLC. So what happens is when there's a single member LLC, then the LLC is called a disregarded entity. And that means that it does not have its own tax return, which kind of means you don't have to worry about a tax return for that. You don't have to pay for that tax return. And you still have the legal protection, but the income and expenses, the net income, all of that goes eventually on the individual tax return, right? But it still has that protection of the LLC. When there's a partnership, which is usually, I would say like 80% of the time, there's a partnership because either a husband and wife, multiple people want to put, pool funds together. That's usually what I see with real estate. And so with a partnership, what that means is that you have the LLC. So, you just pick any state. We'll just pick North Carolina. Like I said, it's where I'm from. You organize an LLC, all right? So you have that. And then the LLC has two members or three members or multiple members is really the important thing. What will happen is that the members will contribute cash into the LLC. So person 1, 2, 3, 4, and 5, they'll all put in 100,000. So now the LLC has $500,000, and then that LLC will purchase, let's say, a building, or usually when it comes to multifamily, it would be a lot more. Then when it comes for tax time, that LLC is filing a partnership return, so a 1065. From that, the division of, say, it's all 20%, just to make it simple. So everyone's going to get 20% of the net profit or loss from that property, and it just flows through. So, I mean, the good thing when it comes to real estate and entities, I think perhaps some viewers may think, well, there's just so many different options, S Corp, C Corp, I've heard LLC, I've heard Inc., I've heard all that. But when it comes to real estate, it's actually pretty simple. Most of the time, and, we would always want to look at the person's situation. It's going to be an LLC and it's going to be taxed as a partnership. If somebody wants to own real estate through their self-directed IRA, that's kind of a whole nother discussion. And there would be a reason for doing that would be because there's a lot of rules when it comes to owning real estate in a self-directed IRA. But, if someone says, okay, well, I have 50,000 cash free and clear right now, or I have $300,000 in an IRA. Well, I'd like to use that cash instead. So that's kind of the reason why somebody goes to a self-directed IRA. But outside of that, I would kind of expect, and there's a lot of people who are in that situation, but I would expect the majority of your listeners are saying, I just want to invest in real estate. So LLC, tax as a partnership.
So how does it affect the self-directed IRA? How is that compared to someone using their direct cash to invest? What's the implication of using your self-directed IRA?
Okay, so very, very good question. So let's say there's no LLC, right?
Right.
Yeah. Okay. So what happens is if there's no LLC, it's really a liability issue. Like the tax issue, this would only really be applicable if it is owned by one person. Because if it's owned by more than one people or more than one person, assuming they're not husband and wife, you kind of have to set up something. It'd be difficult to own, like you have to have an entity. One entity owns a building, or I guess, multiple people could buy a piece of real estate, but that would be really complicated. Like different investors who are not related, that would just be very problematic. But the main issue, Bibi, is that when you hold real estate or any asset in that matter, like assuming not stocks, but like you hold a business or real estate, but primarily real estate. And if there's anything that happens, a slip and fall, someone gets hurt, because, a lot of, with multifamily, I mean, there's like, who knows how many units and somebody could get hurt. If there's a lawsuit and a liability and there's no LLC, then that lawsuit goes to the owner, which is the human being who owns that property, which means their personal assets could be seized and that could ruin somebody's life.
Correct. Yes, because for our because we do a lot of syndications. For our syndication deals, we create 2 or 3 LLCs LLC structures. One is the holding, and the other
Mhm.
one is where we have all the investors putting their money and all
Yeah.
that. So at the end of the year, we do a cost segregation, and we also give them K1s
Yeah.
from that LLC that all of them have put in their money into and all that. So it's a
Yeah.
very efficient way of how people can really structure their deals
Yep.
and take advantage of the tax opportunities in it. So now my next question to you is long-term wealth building with true tax planning. How does investors create a long-term tax plan that aligns with their wealth building goals through multifamily real estate? I remember we had a conversation just barely a few days ago on
Yep.
how they could structure themselves so that they can take advantage of the tax benefits. So my question to you is, how will an investor create a long-term plan in achieving the wealth building goals? Because I know it
Sure.
has a lot to do with structuring.
Yeah, no, for sure. I think many people have heard about the various different types of asset classes when it comes to
Right.
building wealth, and there's not that many of them. So it's typically talked about real estate, commodities, currencies, or businesses. And outside of real estate, I mean, me personally, like I can probably somebody would disagree with me on this, but I don't really like chasing stocks or currencies or
We're in the same
commodities.
boat.
Yeah, I mean,
We're in
I'm
the
not
same
really
boat.
interested in doing that because you
Right.
basically, I mean, I think you have to just either you hire someone to do that and then you're losing money on the fees that you're doing that, or you're just so good at it and that's what you've been doing for the past 20 years anyway. Businesses, yeah, I mean, it's great, but there's like personality issues there. Like there's just a myriad of issues that can happen where all of a sudden you wake up and two people are fighting within the business and the customers aren't there and then you have to work on marketing and all that kind of stuff. So, I mean, my personal preference when it comes to an asset class is real estate. So now the question on long-term tax planning and long-term wealth planning, I think the good thing for someone to think about is when I'm 65, how much cash do I want to have in my pocket? I think it's a good thing to have. And, generally the people that I'm working with are like, I'd like to have 5 million. I'd like to have 10 million of cash. Or they want to say, I'd like to have a more common discussion is, I mean, who wouldn't want, $10 million of cash, right? But
Oh,
probably more,
more want it. Or
yeah,
more. I want
yeah.
more.
Probably a more common discussion is, well, you know what? At the age of 65 or 60 or even 55, it depends. And, someone could say at the age of 45, but, at a certain point, I want to have $100,000 or 200, depending on the city you're living in, of passive income. And I don't want to do anything. That's just my goal.
Mhm.
Or they could say, no, I want to work, but I want to have that as a backup. I mean, we talk about life insurance as well and just insurance in general, specifically with term life insurance. And if that terminates at 65 or whenever that date is,
Yeah, 70. Some, I think some at 70 or
so yeah,
75.
yeah. I mean, unless you have a whole life insurance policy, which really costs a lot. I mean, I think not to make too much of a digression, but the best time to start a whole life insurance policy is when you're born. That usually doesn't happen. So therefore, what you have to do is when you say, oh, I should get a whole life insurance policy. How old am I? I'm 40. Wow, that's going to be a lot of money every single month. I'm not really sure I want to do something like that. So with term life insurance, like, well, that just ends. So what happens if, let's say, once, I would pass after the age of 65 or 70, what happens? Well, you don't have anything. Well, then therefore I have to have something else. And I think a lot of people are also more and more disenchanted, rightfully so, with the idea of possibly getting pension from a government in the future. Like, who knows if that's going to happen, right? Or if that's going to match inflation by that time as well, too. So long-term wealth planning, with the clients that I work with are generally, okay, well, I want to have that much in cash and that much cash or this much cash in my bank account and that much passive income coming in. And so with real estate, I think the benefit of that is that you can pretty much put that on a spreadsheet and like, all right, those are the properties that I'm looking for. That's the amount of income that I'm going to be getting. I should be able to, and we do this all the time. That's what I'm projecting to have as far as assets and income. And then, with an asset, I mean, as opposed to stocks or even an insurance policy, real estate generally can't disappear. And even if something happens to it, you have insurance on the building. If, let's say, there's some sort of eminent domain or condemnation, what's called an involuntary dissolution, there's something called a 1033 exchange, which I didn't mention before, but that's something where you can actually do the same thing as a 1031 exchange. It's a whole nother discussion. But with real estate, you can basically plan it all out quite scientifically, sitting down. You can look at for a particular type of property. I mean, there's so many things available online, even like MLS, or depending on the type of property you want to look for, like say the commercial MLS. That's the property I'm looking for. That's going to be the cap on that property, or that's the return on investment. So as long as I can put those funds together, I can kind of automatically know generally what amount of money I'm going to have when I'm 65 and how much cash I can get. And I think that's the beauty of real estate, as you can kind of see
Yeah.
that. You can't see that with any other asset class. Business, no. Commodities, no. Stocks, no. I mean, you just can't do that. So
And that's what I try to encourage people, that they need to start investing in multifamily, because these are real investments. investment. I would not criticize anyone doing stock. I don't do it because one, I do not understand it, and I do not invest in something that other people have control over. When I mean other
Mm,
people, maybe an Elon Musk comes up today and says, "Hey guys, I'm done. I'm moving my stocks." That's the end of
whatever.
that. That's the end of that stock and all that.
Like
No,
this in a day.
exactly. In a day, it can go from 100 to 0, So,
Yeah.
but for multifamily, as long as you buy the multifamily well and you're operating it well and the economy, the economy is good and everything, that property will yield what it's supposed to yield or even more. Even in the worst case scenario, I have a friend that was about going through a foreclosure, but the thing didn't pull through. She didn't do it, but she sold it for lesser the price. Yes, that was a bad one for her, but guess what? There are tax benefits that will come to the investors because they actually lost money, and that's going to come to them as negative K1s, and you can use that also to write. So even in the worst case scenario, there are still very good opportunities in multifamily. But regardless, nobody's looking for properties that will foreclose or you're going to sell below the value of it. But I'm saying even at that, you still see some little values even at the lowest point of multifamily. So this is why I'm always encouraging people to try and start investing in multifamily. So this is my last question to you before I ask you what do you want the audience to go on with. What are the most significant tax advantages that multifamily properties offer compared to other asset types? I know you said it from this other one, but I just want you to be specific.
Sure. Well, I think the best way to look at this is to consider what are the other real estate opportunities. And
Thank you. That's the best.
yeah, I mean, one could invest in a massive tower, like, but we're talking like $50 million, like things like that. And, a lot of times those are invested by institutional investors. I think, your viewers being the entrepreneurial real estate investor, there's industrial, yeah, but that has its own aspect to it as well. And I guess the reason that multifamily works really, really well is that in good times and bad times, people are looking to rent properties. So in bad times,
Right.
houses are less affordable, they need to rent. In good times, maybe not in the same city, but people can choose where they want to invest. Cities are growing. And so when cities are growing, people are moving there for jobs. And a lot of times what will happen is that people are going to rent before they buy for two reasons. One, because they don't know the city, and also they want to find out where they want to live too. So it's like it works both ways with the economy. The other type of obviously real estate investment opportunity are single family homes. And I have a number of clients that do that. But baby, I'm going to tell you that when I talk to these other clients, you see how busy they are, like
Oh,
physically
yeah.
busy. I mean, they're like running every single day, buying, looking at a property because usually it's just them and they're everything. They're the buyer, they're the renovator, even though they're
They're the
hiring somebody to actually do
manager,
the
they're
renovations. Yeah, they're the
everything. Yeah.
manager and everything like that. And we won't talk about someone calling at 2 o'clock in the morning, the toilet's clogged or something like that. And that's not the main issue. They're also the tenant manager as well, so they're having to manage the tenant because they're not going to have a property management firm, like a really substantial property management firm for one property. And yeah, you could have it for multiple properties as well, but you're not dealing with a stable, similar type of asset. So there might be more fees with that with a property management firm. I mean, people do it with single family, but it is a lot. I think it's a lot more work. And I believe the return is less as well too. I mean, like people who are doing this, they're, making between 7 and 9% return on investment. In multifamily, people make, I've seen a
A
lot more,
lot,
a
a lot
lot more.
more.
And baby, what I saw, I mean, I remember before you and I met, I was dealing, this is like 10 years ago, there was a particular set of investments that were going on throughout certain cities in the United States. And the idea was to buy a multifamily property, and there is a certain amount of, let's say, equity plus some lending as well. And then you buy the property, and usually you get some guy or girl to look for properties that are a little bit either off market, below
Of
market
market.
price. And then, let's say 10 million. And then what you do is you buy it for, let's say 7. You renovate it, and then immediately the value goes to like 15, right? Or
Exactly.
even more. Then you refinance it. So refinance it at, let's say 75%. That's obviously going to cover, the amount of investments that went into that. Everybody gets their money back. They still own the property, and they're still getting money from the investment. And you can't do that with single family. You can
No,
only do that with multifamily.
it's very difficult. That's why I try to discourage people. Remember, we had some single families that we were managing, and remember 2021, it was a disaster because it's a lot of paperwork,
It is.
because you have to portion those properties into different categories and all that.
Yeah.
But remember, the syndication was just a one-time thing. We just submitted our income statement and voila, in 1 week we got our tax returns. And it was like, what? So this
Yeah,
is, I always tell people, try and invest in multifamily. Multifamily helps you scale faster. It takes off the
does.
burden from you. I was working a lot when I was handling multifamilies, a lot. Every minute, every hour, I'm receiving calls. Sometimes the house is trashed. I remember having different tenants trashing the house, and I'm spending the entire 1 year rent I collected by 1 year
Yeah.
profit on just one renovation. It didn't make
Yep.
sense to me. And those are
Yeah.
things you not find in multifamily
No, no, you
because
don't. Yeah.
you
And
have
even
it.
I just read in the Wall Street Journal that, there is a significant decline in the number of single family home sales or just home sales in general. And when real estate goes down, yeah, I mean, kind of all real estate may feel it. The single family homes, they feel it the most for sure. I do
Right.
find that multifamily is very insulated. It can take those shocks really,
Hmm.
really well. And
Especially when you're operating it well.
yeah, exactly, exactly. So yeah, I can't say enough good things about it. I think people should definitely consider it, and people should try to escape from the. I think the dark secret of the investment world is they want to make people believe that investing is too challenging for them to understand. So you might as well just give your money to an investor. But the good thing with real estate and multifamily in general, you can get really, really good on understanding how it works. And I think a lot of times people realize, okay, this is going to be my investment asset for the rest of my life. Because why would I go anywhere else? If I can just give another example, just real quickly. So when I was the CFO of a company, it was an international beverage distribution company, natural beverage, and they were sourcing things out of Asia, but they were making at one point like $8 million in sales per month. But we had a decent amount of cash that we were spinning off the business naturally per month. And in addition to running the finance of the business, I was also running all the investments for the owner as well too. But I got to tell you, out of all the investments that came along, we put the majority, like 80% of our money in multifamily. Like I'm serious. Like we just, because I was saying to the owner, I was like, look, you're getting 21%, and I can't say that it's going to be for everyone, but the idea is that you get a much larger return on investment. Like you're getting a significant higher return on investment. I mean, like it makes no sense to put the money anywhere else. I'm just going to consistently put it in multifamily.
It was really a nice conversation with you. We can go on and on and on. But guys, I really want you to know that with Pro CFO, they were able to reduce our tax projection because we're supposed to pay taxes of maybe 700,000 plus for our 2021, but we're able to legally write off a lot of that and we paid under 100,000. So this is why you need a very good company in managing your tax returns because you never can tell the type of opportunities that you have. One of the reasons why I like Pro CFO is that they follow the house. Any changes that are happening, they get to inform us and all that. Even with Wealthability, they have these weekly meetings that they engage we investors to educate us on what is happening and how we can take advantage of it. So, Michael, how can people reach out to you for tax purposes? How can they reach out to your company? Because you guys have been very valuable to us, I must confess.
Well, I mean, you're awesome to work with as well too. That's really no, it's a pleasure for us as well too.
Yeah.
Our website is www.procfo.com, and people can go to the website and contact us there. We have a YouTube channel, and more importantly,
What's your
we're
YouTube
there.
channel?
Yeah, yeah. Well, we're actually renaming it right now, so I'll have to give that to you. You can show it in the show notes later. But
Okay.
we're also very open to like we had just the other day to have discussions with people and help them kind of guide through what they're thinking because I think a lot of times people when they're approaching real estate, many people may think, well, there's just so much I don't know. But then when we talk to them, yeah, I mean, yeah, there's a part that the CPA firm handles, but we help them become more knowledgeable about generally how it works, and then they're more comfortable. And you know what happens, baby? Then they
Mhm.
invest, and then their
Of
wealth starts
course,
growing.
they do. They do. I
They do
think
it
we
right.
had that conversation with one of my investors, and they were ready to invest, but they did not understand how to structure their business to ensure that they're investing in the right way. And just with a 40 minutes conversation with your company, with you, you're the one that did the presentation, that was just all they needed. And let me tell you for a fact, they're investing in the deal. So it's very, very important for you to have the right CPA company as part of your team. Very, very, very
Well,
important.
you guys are doing great, baby. You really are. And I mean,
Thank
I'm
you
just
so much.
it's such a pleasure to work with you, and I'm really
Same
excited
here.
about what you're doing as well too.
Thank you so much. Thank you so much for taking out the time to educating the audience. And I know so many people are going to listen to this afterwards. And anybody that's listening to it, there are other opportunities. I tell people there are four ways you can make multifamily to achieve your financial goals. Is one, for multifamily, you can get cash flow. You can also get tax benefits. And the only way you can get that tax benefit is having the right tax partnership, tax company handling that for you. And the third one is through the exit strategies, like if you want to refinance and afterwards you want to sell. Those different forms are ways that any investor can make money. And these are ways that you can build wealth. I cannot overemphasize the importance of investing in multifamily and also having the right partners to help you navigate the entire space. So thank you all for taking out the time to being here. Michael, thank you once again.
Thanks,
And
Vivi.
everyone, see you again in 2 weeks. Thank you all and have a wonderful day.